Welcome to the Daily Update. This is being prepared Thursday, May 26th, where we'll look at the action in the market today and then see how things look for Friday, May 27th. And we had a positive day, and a lot of our charts are starting to show some improvement. Things are seemingly turning a little bit more positive, even though our fear is still extreme negative. The thing that we have to watch for now is this just a bounce before we wear off an oversold condition and maybe have people not be as scared before we get set to go lower? Or is there something really behind this move that will actually do something this time and last more than just a few days? Let's go back over Thursday. Right at the open, we did have a gap higher. Things were positive right from the start. We opened above R1, which was at 4,010, so we were able to get back above 4,000. The thing that we had trouble with on Wednesday was we got right up to the 4,000 level, and that provided resistance. Well, on Thursday, we were able to get above that. Buying then took prices all the way up to R2, and we even went above R2, which was at 40.42. As the day went on, we did go above R2. We hit resistance at the previous long-term support level of 40.57.84. That's the big long support line that I've been putting on the daily chart. Well, it was support, and then we broke down below that. Well, with Thursday's action, we've gone right back up to that level, and it's now acting as resistance. Prices then drifted sideways for a lot of the day. A lot of the high was put in. We didn't see a lot of selling coming in. We just kind of floated. Going into the close, prices did retreat a bit, and we closed just slightly off the high. We ended up being up 1.99%. Volume was still below average, but we've been below average all week so far. The technicals are still negative, but man, they are really starting to turn more positive, and I'll go through the charts and show you that. We're still fixated on the inflation and interest rates and growth concerns, the geopolitical concerns, as well as the earnings. Now, on Thursday, the earnings reports that came out, a lot of retail sector earnings, the market seemed to like that. They seemed to treat those pretty well. And that kind of provided a positive backdrop for everything. We'll have to see what happens on Friday. So some comments that we can make. We did regain the 20-period moving averages. And that's the simple moving average and the exponential moving average. It moves the quickest, so when we're going back up, it's what we're going to hit first. I'm still watching the VIX. It declined a little bit with that little spike that we're trying to watch there. Fear still remains extreme. We're still in correction territory, and the technical indicators are showing continued improvement, and some have even turned positive. Looking at the economic reports that came out, we did have jobless claims, which decreased by 8,000 to 210,000, and that's what they expected. The second estimate for GDP, it was revised down to show that real GDP is decreasing at 1.5%. The initial report, or the advanced report, showed that we were down 1.4%. Now they're expecting 1.5%. They had actually expected it to be down 1.3%. And then the chain deflator, which is another inflation measurement that we use, it was revised up to 8.1. And they expected it to be at 8. And in the advanced reading, it was at 8. So inflation has gone up and GDP has come down slightly in this second estimate for GDP. Pending home sales ended up declining 3.9%. Our trend is negative, but it's getting weaker. With the strong up day that we saw, the ADX is starting to turn down, crossing a bit below the moving average, but it's still negative overall. The bias is positive, and I'm switching the momentum back to mixed with more of a positive slant because we're in danger of just seeing this go up 1 or 2 days and then come right back down. I am preparing a video which I hope will address part of this, and I'm bringing up the premise that every time the market tries to bounce, it's not very sustainable. And why is that? So the hypothesis that I'm coming up with is that the markets can't sustain a strong and lasting recovery until the Fed makes a shift in policy. Now, their current policy is raise interest rates right now to deal with inflation. And then When we get that under control, then we'll worry more about economic growth. If there's something that comes out, even if it never happens, one of the things that I'm doing research on was something that happened back in 2016, and it was just an article, and it was from Chairman Yellen just suggesting something that never did end up happening, but just the fact that she suggested that was a real catalyst for the markets to move higher. So the bounce is defined as possibly a counter trend move if we have that, or some renewal of the bull market that lasts more than a few days that may establish a new all-time high. That's what we're waiting to see. On the charts and on sentiment and everything else, it looks like we could get a bounce. What's holding that back? My personal opinion is it could be Fed policy. And until they really shift into a way that the markets really like, we're kind of destined for things to go up a little bit and then down, go up and down, and go up and down. Pretty much what we've seen for 2022. My intentions are to post this video as soon as possible, but it'll probably be over the weekend. This will be added to the list of possible positive scenarios. And we're just kind of waiting for this to happen, if it even does happen. So let's go back, look at the day's session, first by looking at sentiment, where we're still extreme negative. Yeah, we're bouncing up a little bit, but we're still in extreme negative territory. And that usually is a contrary indicator, meaning that there's excessive fear, so we're looking for the market to go up from here. But we've been here for a long time, as you can see by the area that I have circled. When we're below 25 like this for a long time, it's just like people are afraid and staying afraid. The VIX did decline on a closing basis, and we gapped down with the bar chart. We actually gapped a little lower, and we're starting to come down a little bit below the moving average, at least on this chart, where we're right on the moving average with the line chart. Also looking at the VIX of the VIX, it is showing a real decline on the bar chart as well as on the line chart. Just shows that the VIX is settling down a bit. One thing that did come out was our weekly survey of individual investors, and even though it jumped up a little bit, we are still extreme negative overall. So that's feeding more into the fear side of things, and we use this as a contrary indicator. Another thing that came out was the Ridex bear-bull ratio, where we had spiked up. Well, as things are looking a little bit better, this is starting to come down slightly, which just means that people aren't getting into the bearish funds as heavily as they were from previous readings, and now they're looking more at the bullish mutual funds. Here's the VIX chart that we're watching, and we're seeing it kind of declining on a moving average basis here. Down below is the S&P 500. We're spiking up when we're looking at the correlation between the two, but it did fall back a little bit. Where we're really going to pay attention to this is if we go above the dotted line and then see what is happening in the market at that time. Now, it doesn't necessarily mean we have to get to that dotted line. That's just an area that I've marked here on this chart. But we want to just see, is this telling us something useful? We don't really know yet. Another survey that came out were the active asset managers. And there was a bit of an improvement. They were really extreme negative last week. Well, we bounced up to 33.19 this week. And then down below is the corresponding S&P. And you can see, to a large degree, this is an oscillator. So it goes within a range. Where if the S&P is going up, we'll see this line go up. If the S&P is going down, we'll see this line going down. This on the top is an oscillator. So when we get down to an extreme reading, below 40, 30, or even down below 20, that just shows excessive fear with the active asset managers. They're getting out of the risk on investments, which means stocks, and they're getting more into risk off. Well, we saw that rebound a little bit since the previous week. Another thing that came out with the real GDP and the deflator, the blue line is just showing how GDP right now is looking to be down 1.5%. The orange line is the deflator. This is measuring inflation, and it is actually going up. The Ulcer Index is continuing to fall, which also is suggesting that fear is coming out of the market. Also, the indicator is probably recalculating at the same time. And here is another look at that indicator. The 5-period simple moving average of the equity put calls, it did decline, as you could probably expect on an up day, but we're still at a pretty high level. This chart is just showing the cumulative change in real S&P 500 and real profits. Basically, the thing to understand about this is when the blue area is on top, we're generally in a bear market, so we're headed lower. When this is below, we are in a bull market. Well, where are we right now? We are above. So that is suggesting some of the negativity that we're seeing. You can see back in the dot-com bubble, the blue really got way far above. Coming out of the financial crisis, the blue was below, and that really helped things to move higher. Well, now we're back in what's considered to be bubble territory. One article that I ran across in MarketWatch is an opinion, so you have to take that for what it's worth. There's strong insider buying, which suggests a 15% rally in the S&P 500 from now, which this was first published on May 25th. Here's the chart that is cited in that article, and I'll include the link in the YouTube description. This just shows that when we get to a really low level, that has often marked a bottom in the market. And the lines are kind of, you can line up with what the S&P did. It says right here, March 2008 was by far the worst signal on record. Well, if you're a shorter term trader, you could have profited from that before things really sunk. And sometimes we're a little bit early. It can push up things, but then end up going lower. But this is just measuring insider block trading. These are the folks that have a transaction of 100,000 shares or more or $1 million worth, and those are big blocks, either of buying or selling. And this is the net number of insider block sales as a percentage of the issues that were traded. We're at a really low level right now. You can see we also bottomed out at the COVID bottom as well. Can this help the market sustain some kind of upward movement? According to this article, they say yes. But it's an opinion piece, and there's lots of other things that we look at, so we kind of have to take this as just one part of our overall picture that we use to make decisions. Let's go in and look at the different sectors. Discretionary was up the best because it's been down the worst, and people saw some bargains in there and decided to go in. It was up 4.9%. Comm and tech, they were up well over 2%, as were the financials, industrials. The areas that really have been getting hit so far this year, they ended up doing the best. And there was one area, real estate, which was down slightly. And here is the chart. Again, I feel like a broken record with this, where we have energy and then utilities. And then in last place, even though discretionary had a really strong day, it's still down overall, as is comm, tech, and real estate. Going through the technical alerts, they were all positive. The S&P got back above 4,000. That's the only one I see in here for the S&P. But a lot of these are on the NASDAQ and within sectors, and we're seeing a lot of improvement as far as the technical alerts that are being triggered. We saw a lot of positive ones yesterday. We're seeing more positive ones today. Looking at the intraday chart, we did gap higher right at the open, right above R1. We quickly went up to R2. We even broke above that, and it's not on this chart, but the upward resistance that we hit is that long-term support line that I'll show in the next chart. We came down a little bit after drifting sideways for a while, tried to bounce back up, but then saw a little bit of selling going into the close. Here's the long-term support line, and this has been on this chart for a long time. We had come down, and I kept citing this as we were coming down, that I hope we don't break this, I hope we don't break this. Well, we did. We actually broke below it. We came all the way down to another support level on the daily chart of S1. We've been able to bounce up off of that. We got through this other pivot point, and now we're right back up to what is now the pivot point, which is the same place that this long-term support line is. And again, it just amazes me how these things line up with each other. One thing to be concerned about is, even though we saw a bit of an increase in volume, it was still below average overall. You've got a lot of people that don't trust this, and that could work to the market's favor. It can't go higher, it can't go higher, and it keeps going higher. So we have to look at the charts, reach our conclusions, make actions that way, and then forget about what you're feeling like. You have to go with what you actually see. All right, we're down 15.4% from the all-time high. Our technical overview, and nothing's really changed here. The things that had been positive remain positive, so the list has not changed if you watch the videos on a continual basis. The things that were negative continue to be negative, so I'll just rattle this thing off here. So let's look at the trend. We're seeing it coming down a little bit and trying to cross below the moving average. The red line is really starting to come down. And it's not its relationship into the black line. It's the relationship between the red line and the green line. When these cross, that's when the trend will turn positive. And they're still far away from doing that. But we are potentially seeing the trend start to weaken as it drops below the moving average. But it's still a negative trend, and it's still a trend because we are above 20. The Arun is seeing a decline based on selling pressure, but also a decrease in buying power. So overall, we're still flat with the oscillator, but it's a negative because it's below zero. Looking at breadth, had another good solid day based on price and volume. So we're going above the moving average based on price. We're seeing an upward movement based on volume, but we're still underneath a declining moving average. Our waterfall chart here is also showing some improvement after giving us a real extreme negative reading. The advanced decline ratio is turning more positive. You have both the blue line and the red line above zero, with the blue line really advancing. New highs and new lows are now starting to trend higher, both on the 5 period and down here on the 10 period. Accumulation distribution is also showing some improvement. Short-term charts, we are back above the 20 period simple and exponential moving average. McClellan oscillator is positive and starting to get extreme positive. The force index turned positive after being negative for quite a while. Stochc RSI also starting to get extreme positive, but this can stay this way for a long time. Williams percent R also really shooting up into extreme positive territory, but it can also stay pegged at the top, just like it stayed pegged at the bottom for a long time. The 20-period exponential moving average study is advancing, 50 is advancing, and the 200 is advancing. Stochastics starting to get extreme short term, looking much better and turning positive in the intermediate term, and starting to turn up from an extreme negative reading with the long term. Our intermediate term charts, we're still seeing a bit of a mix. The slope is positive, the MACD is cross positive, the KST is trying to cross positive, the TRIX is still negative but improving, the PMO is trying to cross, and the TSI is turning more positive. The Vortex is seeing a decline in selling and an advance in buying. The Sean trend meter is finally coming up out of extreme negative territory, and unless we start to really go lower after this, I'll probably not show this chart for a while. The Swinland trading oscillator, advancing based on price and volume. BPI really had a good solid up day. It's not really considered positive until it gets above 50, but after where we had been, this is showing much improvement. The PMO, as I said before, it's trying to turn over positive, and we're seeing a real improvement based on price and volume. The PMOs that are rising is positive and getting extreme already. Didn't take much for that to happen. The buy signals are positive, and we're turning up with those that are above zero. The summation index based on price and volume continue to advance. The boom indicator, we're finally getting out of extreme negative territory with the 50 period moving average, and we saw a bit of a bounce on the 200 measurement. This next chart is a little bit of a concern because we're seeing below average volume, so that's why we're seeing this trailing off right now. This doesn't measure price movement. This measures volume intensity. And as we've been going higher, for us to see this going down, that makes us suspicious. But we still have to follow price. Volume is very important, but price is ultimately what we have to use to determine things. TTM squeeze showing some improvement, and we've been able to get back above the anchored moving average. And here's the longer term view showing that we're trying to bounce up. Different charts, Hike and Ashy, looking much more positive. We have a couple of open candles here now. The Kegi chart, which turned positive yesterday, remains positive, but the Renko chart still remains negative. It needs to see more price action. The 3-line break is also showing some improvement. And there's no signal now generated on the point and figure chart, but we did have 4 new green X's in here, so that's positive. It had been predicting a breakdown. Well, with the advance, it's taken that pattern away, and there's currently no pattern, but this is looking a little more positive now. Our different trading systems, the Elder system for the S&P is now positive because it's green, as well as for the SPY and the SAR. We have a second day of the dots underneath, so that has now switched over to positive. The go, no-go system is now back to more neutral because instead of being a dark purple, it's more now a lighter purple. Long term, we have a ways to go before we get back to the 200-day moving average. Our 50-period moving average is showing improvement, as is the 150 and the 200. Special K, trying to turn up ever so slightly, but it's got a ways to go to get back above this moving average, and it still isn't really turning up with any conviction yet. Looking at the broad market, the diamonds are now positive. They switched positive yesterday and remain positive. The Qs have finally switched back to being positive after having been neutral. The Vixen is showing a real decline, and we're dropping below this moving average. The line chart is also dropping below the moving average. So looking at the dollar, it declined a little bit. And so are we starting to see this spike that I've been talking about? On May 16th is when I found this chart. We're getting back down around this red line now. Is it going to keep falling? Which could actually help stocks. Because a lot of the reason people are pointing for stocks having so much trouble is that the dollar has been really going up. And if it continues to go down, that might provide some catalyst for stocks to go higher. Oil closed at 114.09. It was up 3.41%, so getting very high. Here's another prediction put out by Goldman Sachs that we were at 112 when they came out with this. They're thinking that we're going to go up to 125 and top out there, and then eventually fall back down to 115. Where the futures market, that's the blue line, they're predicting that we're actually going to fall even more. The gold futures were up slightly and still battling around the 200-day moving average. Here's the ETF. Also, the moving average has been acting as support. And here's the longer-term view of the ETF. One thing that I ran across with IsabelNet is, if you go back to the gold chart, it's thinking, is this a double top? According to this chart, they're saying, is this possibly a double top? Silver, we're starting to get close to a death cross with the moving averages, and we were down slightly on the day. And here's the longer-term ETF. Looking at bonds, we declined a little bit with this bond index. And yields, the 30-year yield went up, where the shorter-term maturities actually came down, and the 3-month actually turned up a bit. Our possible positive scenarios, the Copic curve is just showing us that it is going higher. This doesn't tell us what will happen. We might want to default to this being positive, because as this line started to cross, we saw a bit of an improvement with the daily charts. The 2-year Treasury, has it spiked? It declined, but we don't really know yet. The mass index is just slightly above 26.5. It's at 26.54. And again, if this does trigger, which it looks like it will now, this doesn't necessarily tell us the direction. This just tells us that something big should happen. Where this does tell us the direction. This measures lows in the market, and we've crossed positive, and this continues to go higher. The small caps showing a little bit of a spike, and they've actually been doing quite well the last few days. Is that going to help the S&P continue to go higher from here? The staples ratio actually came down a little bit. So yes, this is now back to looking a bit more viable at this point, but we want to see some follow through based on price. So what's our outlook then for Friday? The technicals are negative, but they continue to improve with some of our indicators actually turning positive. Sentiment is still extreme negative. There's the growth and value battle that keeps going back and forth. Economic reports coming out. We have personal income and spending. And then the advanced international trade will be coming out. Retail inventories, wholesale inventories, and then the final reading for the consumer sentiment that we got a couple of weeks ago. It'll be coming out on Friday. Geopolitical events, pretty much the same. Russia, Ukraine could be positive or negative. It looks like they're really starting to end the lockdowns in China, so that could help some of the supply chain issues. But the market's still worried about inflation, interest rates, and growth concerns. Oil continues to go higher. We want to keep an eye on that. Earnings, good days, bad days. We've had our share. Fed speak and then policy. This is what I'm talking about with, is the Fed going to come out and announce something that the market really grabs a hold of and uses that as a catalyst to really move higher? And then we want to keep an eye on things in Japan. So our scenarios, we're still down for right now because of rising interest rates, inflation fears, growth concerns, earnings, Fed speak, and policy. The recent trend of selling into strength, I added that. Are we going to be able to get some momentum if we continue to go higher from here? The technicals are still pretty negative overall. Now, what can help us go up from here? We're seeing an improvement in the technicals, and some are actually turning positive, and sentiment is still extreme negative. And then the possible positive scenarios, the Copic curve that I showed, the bottom fissure, they've turned up. The staple spike is looking more viable again. The technicals, which we have pivots, fib retracements, and previous levels, and we can even add a moving average finally, the 20 period. Will that act as support or resistance? Right now, it would be support. Neutral? No. We're not in a neutral environment now because the ADX continues to be above 20, and with the red line on top, that is a negative trend. So our conclusion then is the S&P is negative, short-term negative but showing improvement, intermediate term negative but improving, long-term still negative. So thank you. Have a wonderful Friday, and I will try to prepare the video for Monday just as soon as I can.